sorry, I'm being, embarrass you. But anyway, the next to him, is Joseph Liu, who is professor at National Tsinghua University in Taiwan. But before that, he was Minister of Finance in Taiwan. So, we're so grateful for him to come and honor us with his presence. And then this elegant lady is Yang Hong, who is Managing Director of CICC in charge of the research department, and previously, of course, with Goldman Sachs and IMF, one of the most respected commentators on the Chinese economy and on the region. Richard Koo needs no introduction because he's so well known as chief economist of Nomura, and his book, on the balance sheet, a completely new framework to look at not just the Japanese crisis, but also the Asian crisis and the current crisis. Larry Summers said he's learned a lot from it, so he's accepted, Richard's views. I thought it was very good. Last but not least, of course, is Peter Jungmann. Peter Jungmann is chairman of Peter Jungmann Holdings, but he's always a very important businessman from Germany, and he was voted one of the 100 most important personalities who are helping to shape the new economy. So, Peter, we're looking forward to you to talk a little bit about Europe. So let's start, because Joseph, you have the plane to catch, and you'll be the first one to start on your vision, okay?
Thank you, Andrew. Our honorable moderator, President Shen, all the discussants, distinguished guests, ladies and gentlemen. It's a great honor for me to be invited to participate in discussing this subject. I think over the past 24 hours, we have learned a lot about Asia's growth, so we don't need to repeat. But the key thing is that Asian countries as a whole have demonstrated their growing economic power and interact more and more closely with the rest of the world. At the start of this century, 261 Asian banks ranked among top 1,000 in the world, holding only about 9.8% of banking assets. But today, the number increased to 347 banks, holding about 1/3 of total banking assets. Asia is now apparently critical to the world economy, not only in the real sector, but also in the financial services arena. Today, I would like to contribute my personal views on small and medium business finance. Since year 2008, financial crisis, Europe in general has experienced a relatively slow economic growth. However, Germany, being an exception, has continued its growing pace. Its solid foundation of industry technology, as well as broad and deep-rooted small and medium enterprises, Mittelstand in German, are critical in supporting the country's performance. Today we have Mr. Yunnan here. He will share the insights with us. But I'll talk about the Taiwan side. Taiwan economy is also well known for its solid SMEs. They are the mainstay of our economy, creating not only well-organized supply chains for various industries, but more importantly, providing significant employment opportunities. Currently, we have about 1.3 million SMEs, generating a total annual sales value of about $380 billion, or 30% of total corporate sales in Taiwan. However, as a striking comparison, these SMEs provide 8.5 million jobs, accounting for over 78% of total employments in Taiwan. Again, 30% of corporate sales provides 78% of total job opportunities in Taiwan. Around 85% of SMEs' operating income is generated domestically, which goes well with recent policy shifts toward refocusing on domestic demand and consumption. and re-emphasizing employment creation, especially after the 2008 financial crisis. 56% of them are proprietorship, and almost half of SMEs have operated for more than 10 years. To strengthen the foundation of SME sector, Taiwan has established a full set of institutions and policies, economically and financially. Over the past 30 years, from government to government, we have had 3 major initiatives, amongst other things. First, we reorganized the credit cooperatives into the Small and Medium Business Bank of Taiwan to facilitate the funding need of SMEs. SME financing is not easy and sometimes not always popular to many bankers. Their risk depends largely on the character and capability of the individual proprietor. The risk management requires local knowledge and sometimes the understanding of unique industry practice. Not all the commercial banks are well equipped to entertain these segments. A bank being specialized in servicing SMEs has proved to be an effective policy in Taiwan. Second, we set up the Small and Medium Business Credit Guarantee Fund in 1994 to provide guarantee for SMEs in borrowing from banks whilst mitigating the bank's risk. When dealing with banks, SMEs occasionally find it difficult to prove their own viability. This guarantee fund plays the role as credit enhancer to satisfy the bank's lending criteria. It also helps close the risk perception gap and reduce the risk premium and the resultant credit spread. Third, we set up the Small and Medium Enterprises Development Fund to assist SMEs in technology improvement, market development, and general corporate management. It also participates in the SME shareholding where necessary and appropriate. Most of SMEs are funded by technicians who are in lack of full range of management skills, especially in finance matters and in great need of the professional services and assistance. A bank dedicated for SMEs, a fund to provide credit guarantee, and an institution to provide management advisory services are integrated into the tripod to support the SME development and therefore create job opportunities in an effective fashion. This is the key to success, and I would be very delighted to share our experience, especially with developing economies in Asia. One last thing worth mentioning is that SMEs tend to be very flexible in management and operations, and therefore are quick to adjust themselves toward the environmental changes. As I have observed in my banking and public service career, SMEs owners in Taiwan take their business success not only as a matter of monetary fortune, but more importantly, as their social standing and culturally the face of their families. They always strive to cope with the challenges domestically and internationally. Looking forward, I believe it is the responsibility of us in Asia, financiers and regulators, to create a financially friendly environment to foster the SMEs development, thereby promoting the welfare of the general public. Thank you very much.
Thank you, Joseph. That was very insightful and very, very helpful. And I think the main message about the need to promote SMEs, create jobs, promote innovation is a key area of change. And we all within the region, but not just within the Asian region, but globally, how to do that is very, very critical for us. Now, Rafael, we are going to volunteer you as the second speaker. So, Rafael, over to you.
Thank you, Andrew, and thank you also, Professor, because in fact, how you have expanded on the SMEs is one of the 3 key drivers that we see leading us in the work that's been done between Oliver Wyman and the Fung Global Institute in terms of taking the real economy over into the, the next couple of decades. If SME would be a source of employment, growth, and innovation, which it is, and you have done very well in Taiwan, but it is not generally the case across the other Asian countries. The other two would be continued emphasis on trade and the continued unlocking of infrastructure necessities in countries where there is a high social rate of return. So what we're proposing is that the financial sector be something that is conducive to the growth of the real economy rather than just froth above it. And so as we look at the year 2020, in terms of what should be the characteristics of that financial sector at that time, we see a number of common gaps across the various countries. And I'll describe them, and then I'll provide, just at a very high level, okay, some of the responses that maybe the regulators can provide against these shortcomings of the current financial sector in Asia. The first one, and it's well known, is overly reliant on short-term funding. So by and large, it is based on banking, on loans. There is relatively little in the form of bonds and fixed income. There is even less in the form of equities. So let me just leave it at that, because then that ties with the next point, which is a significant shortage of what is called real money. Okay? To put it in context, in the United States, the amount of so-called real money, which is, say, provided by pension funds and by insurance companies that invest long-term, is 1.5 times the total amount of bank loans. 1.5 times. In Asia, in emerging Asia, it's about 40%, and if you go to China, it's less than 20%. So when you have such a shortage of long-term money, okay, then clearly the only gap is there for the banks, and the banks cover it, but they're not really well equipped. If you combine that with the fact that in China, which is a big driver of this change, the banks make a very comfortable spread dictated by the regulator, then they're simply just very comfortable lending to large companies, the old economy. Most of them are arguably investment grade, and so there is very little drive to innovate and to go into those segments of the economy which, as you have highlighted, Professor, are the largest employers, okay? And in fact the source of innovation and future large companies. So clearly addressing the availability of long-term funding will be critical to develop the capital market that will be able to purchase the bonds to be issued by these investment-grade companies. Now, why is that? And clearly what is happening is that, one, the level of wealth is of course not high, so that is clearly an impediment. But in addition, the financial education of most households is very limited. So they end up investing simply in bank assets and deposits that provides for an ongoing liquid situation of the banks in Asia. This is a positive in and of itself, but it is short term. And anecdotic as well as researched evidence indicates that most savers do not get very good advice from either their banks or financial advisors. The advice continues to be, well, invest in this particular asset because it's going to provide you with a very high return, as opposed to an approach of saying, you know, at what stage are you in your lifestyle, in your life cycle? What should be your risk profile? Are you coping with the needs of your children? Are you investing in the future? Are you developing health insurance, long-term planning? That is absent. So alongside all of this would be a requirement for more education, not just for small enterprises, but generally to the public at large, of how they should manage their own affairs. Let me stop there, because I think I have a lot of data, but it's clearly covered in that report. So maybe we can get to that, and particularly the regulatory approach later on in the conversation. Thank you.
Thank you, Rafael. Let me now invite Richard Koo. Richard.
Well, Asian finance is not my field of specialty either, but I like to share a few of my observations listening to a lot of the discussions here. I think a lot of countries are in Asia are in different stages of development. Some, like Japan, is in advanced stage, Taiwan, Korea, very close to it, and then there are many countries that are about the takeoff stage and moving higher. And when we look up what are the blueprints, well, that's the theme that I was given to talk about. There are, I think, more than one blueprints even in the developed world. And one is the US-UK kind of model, where financial industry became the industry almost, and many of us actually work there. And then there's the Germany-Japan type of model, where industry still remain the key part of the society, most highly valued part of the society, and many people in Germany, many people in Japan kind of shun the stock market. That's not for the gentleman. If you're any good, you're supposed to be making real goods, good cars, good cameras. That's what you're supposed to be doing. That's the whole social value, Germany and Japan. Whereas UK and US, it's more like, if you can make money, however you do it, doesn't matter, just make money. Then you look at the UK and US model. After the 2008 crisis, there has been a lot of soul searching. And in the case of UK, I think there's almost a definite move away from overemphasis on finance to something more real. And this tax on bankers' pay and all of that is trying to steer away from the best and the brightest going into the banking, because to a large extent, the financial market has this element of zero sum. Not all zero sum, but some of them have that element. And if you put the best and the brightest in there, and of course they're going to do very well within that particular area of business, but as someone was saying, they could end up doing all sorts of innovations that are negative innovations. And as Paul Volcker once said, the only financial innovation worth talking about is the development of ATM. And I actually share quite a bit of that, because I had to deal with the banking crisis as I described yesterday, and these American banks can screw themselves up to the nth degree, even with all the warnings from the Federal Reserve, and then we had to clean up the messes afterwards. The same thing happened in Japan in 1997. And so, do you want the best and the brightest in the financial sector, which has a large element of zero sum, or have them in the industry producing something for the society? And if I put it that way, of course, then everybody will say, they should be building something for the society. Of course, nothing is that simple, but this is all matter of emphasis. That if you think the society is built on people who love to build good products, then you should emphasize the Japanese-German type of development. But if your society is culturally made of people who love to trade, love to speculate, love to make money, then maybe whatever you do, the society will move toward maybe the UK-US type of the model. But since I was given the theme that how should Asian financial system enable small and medium-sized firms, manufacturing to prosper, I think the example given by Professor Liu is a very good one, because when you look at the financial system there, the mentality even of the bankers are quite different from those bankers in the West, or the ones in Japan, or ones in the United States, the ones that I'm most familiar with. some years ago, it's a while ago actually, I was talking to a banker in Taipei. It was a bank that no longer has the name left. It's Jiao Tong Yinhang, which was more of a... Oh, that was your jurisdiction. Yes, yes. Oh, okay, but it was a while ago actually. That Jiao Tong Yinhang was about to open its first foreign branch. And coming from my New York background, New York Fair, Tokyo, I thought, oh, it's going to be New York, it's going to be Tokyo, it's going to be London? It was none of the above. It was Silicon Valley. That was the first foreign branch of Jiao Tong Yinhang. And that's a very different type of mentality. And in fact, there were a lot of Taiwanese working in Silicon Valley at that time. They knew what it was like, but there was not a single bank in Silicon Valley that can open LC. So if they had to do exports, they all had to actually travel 1 hour to San Francisco and ask the San Francisco bank to open LCs because there was no bank in Silicon Valley that knew how to open LC. And so this Taiwanese bank, realizing what's happening, opened its first branch in San Jose to help not just the Taiwanese businessmen there, but all the other Silicon Valley types who wanted to ship something out without traveling each time to the San Francisco bank to open an LC. It's that kind of mentality, I think, is what Asian bankers should strive for, instead of making this big money in some wholesale trade, because those really add value. And I think, I'm sure there are more competitors in Silicon Valley from other banks joining it. But this is in, I think, late 80s that you guys opened the first branch, right? Yeah, it was something like that. And so if you have a mindset to help those small businessmen, then there are, as Professor Liu mentioned, many things that can be done. But those takes a lot of effort at the ground level. You're not going to make tons of money with 1 or 2 trades like in investment banking. But those should be encouraged. And if the government can help in any way they can, I think that's a very big positive. And I like that one more thing, and that is that on a macro scale, I think government should also be very careful not to expose small and medium-sized firms to these crazy fluctuations in the financial market. And I'm sure those who lived through the Asian currency crisis or what happened after 2008 realize that these things can be highly disruptive to proper development of these economies. And here too, I have to refer to Taiwan because Taiwan somehow managed both 1997 crisis and 2008 crisis with minimal damage. And how did they manage to do that? Well, because the central bank was very focused on not letting these crazy foreign monies flowing around in the region, affecting the exchange rates, affecting all the this capital flows, hot money coming in and disrupting people's daily lives. And I have known the governor of the Central Bank of Taiwan quite well over the years, and he is one of the most hated central bank governor among the financial types, especially among foreign financial institutions. Why is he hated so much? Because every time some money comes into Taiwan, he gives them a call. Okay, what kind of money is it? Where is it headed? Where is it coming from? What's the duration? And if you get a call like this from the central bank every time, the fund managers and those people who are moving money gets a little scared. And so they typically don't do things funny. And that's why he's so very unpopular. But as a result of that effort, very persistent effort, even though Taiwan is, well, I should say, supposedly open economy, it managed to weather some of these shocks from abroad. And when I'm often asked by financial types, government officials from developing countries, I say, do what Governor Peng in Taiwan is doing to shield yourself from these crazy flows from abroad, because too often the flows from abroad, if they are well-educated flows, they are welcome. But I know, because this is my field, you know, when sometimes the Malaysian stock market goes up, and then everybody's against the Morgan Stanley Capital Market Index or something, and if you don't have a Malaysian stock, everybody has to buy Malaysian stocks just to make sure that you're part of the game. These people know nothing about Malaysia. And when something happens in Malaysia that goes wrong, they panic. And when they panic, it affects smaller economies like Malaysia very badly. And in order to protect that from happening, you have to have the courage to make sure that these people know what they're doing. They know something about Malaysia, so that even if the money comes and something happens, they won't just fly away. And this is not a popular thing to do. After the G20 that took place in Korea, 3 years ago, many countries were given rights to impose capital controls after developed countries went on to this crazy exercise called QE. But even after that, I don't think a lot of countries exercise that power of putting in capital controls very well, because when the capital is coming in, it's so nice, right? Asset prices are rising, people are happy, it's easy to get money at very cheap prices, half of a LIBOR. Only the exporters are hurting because our exchange rate is rising, but everybody else is very happy. And so even though you know that this money may be hot money, may not be a good money, it's very difficult politically to say, no, we don't want this money. And so they let the money in, and when the money goes out, like what happened after May 22nd this year, then everybody suffers again. And so it requires quite a bit of courage. But I hope more Asian countries gain that courage to at least give a call to the money that is coming in to see whether those are educated money or not. Thank you.
Thank you, Richard. I thought you've posed the question very, very nicely. You say you don't know that much about finance. It's not true. You know, you've talked about the U.S., the Anglo-Saxon model, put it this way, versus the German, Japanese model, which is an alternative. Talk about real money, as Rafael has mentioned. Now let's invite Peter Jungmann to give his views about Euro and Mittelstand.
Thank you. The interesting thing is that since about 6 to 10 months, I'm experiencing that the German word Mittelstand has invaded the English language, like the German word kindergarten and Angst. Unfortunately, Mittelstand is making a career in this. So what I'm briefly will be touching is a relationship between the present debate about the European debt crisis, about the current account surpluses that come up, and the role which plays the Mittelstand in this, and the share of industry in this, because this is the key to understand what is going on in Europe and how it affects also Asia. The euro does not unite Europe, it separates Europe. Originally, it was an economic project, but it was turned into a political project with the fall of the wall in '89 and German unity coming. So without German unity, we probably would definitely have no euro today. It has created problems which would not exist without it: low interest rates for all of them, easy money, access to credit, created current account deficits like never before in these countries, and without the euro, a number of countries would never have been able to finance their government debt and the consumer debts on the market. So the euro created divergence and actually not convergence. Greece, of course, is insolvent, actually for the 6th time in its history, which started in 1832, the new one. So the biggest mistake, of course, in handling the European debt crisis was the bailout in May 2010. Since then, or at that time 20% of Greek debt were held by public hands and 80% by the private sector. Now it's the other way around. 80% is held by the public sector, that is the European taxpayers, and 20% still by private. The problem is, of course, not the debt. The problem is this is a structural economy which just doesn't work. In the Doing Business Index of the World Bank, Greece, in the middle of the crisis, ranked 109 out of 170 odd countries, directly behind Bangladesh. I'm not criticizing Bangladesh for that, but it says a lot about the situation. And in the competitiveness index of the World Economic Forum, Greece ranks directly behind Egypt, Rwanda, and Botswana. To understand what I said before, you can look at the foreign debt of a number of these countries, Greece, Portugal, and sort of exploded. For instance, in Greece from 2000, from about 40 billion to 580 billion. Or in Italy, from 45 billion to 2.6 trillion. And you could go on. That is public and private debt. We all know that in the IMF, the bailout of Greece was heavily debated in 2010, and there was a major group led in emerging markets countries who said, why bailout, why not do the normal procedure? And my reading is we will see the new idea coming up to shift the debt because no one expects them to be paid back. So we had a similar committee in the history between 1898 and 1940. There was an International Greek Debt Committee that ceased only to work because of the World War II. Maybe otherwise they would have the same Greek Debt Committee continuously. And therefore that's the reason why Greece only went bust 6 times in history, because it was so long insolvent that it couldn't get it again in this. So what we had there was that poorer people in richer countries were bailing out richer people in poorer countries. And to say simply, the richer countries rescued the poorer countries for them to be able to rescue the banks in the richer countries. That is exactly what happened. In that order, the French bank and the German Landesbanken. And obviously politics thought it's better to tell the people that we show solidarity to the Greek people instead of rescuing again the banks, which in Germany even were government owned. And so that would have been even less popular than to rescue Greece. Actually, when I say poorer people in richer countries, that is private wealth to GDP. In Germany is much lower than in Italy or in France or in a number of other countries, and the median private wealth per household in Europe is the lowest in Eurozone. The lowest is in Germany, although no one believes. Now the question is the crisis over? No. Will it last? Yes. How long? Definitely longer than expected. And why? Because the debts are still rising. They're higher than ever before. So we see 3 risks in Europe going apart. One is inside the Eurozone. The other one is between Eurozone and EU members. And the third is between those countries who are favoring globalization and profiting from globalization and those who try to shield off against that. That leads me to this export debate. Actually, Germany has profited much more from the end of communism than from the introduction of the euro. 80% of export growth of Germany since the fall of the wall went to Eastern Europe, Eastern and Central Europe, and to emerging markets. Since the EMU, German export growth to the Eurozone was an average 8.5% per annum, 10.5% to the rest of the world, and therefore the German export into Eurozone is now historically at the lowest level ever. People say Germany have a high export rate. Well, maybe, but it's only number 8 in the Eurozone and number 12 in the EU. So there are lots of other European countries who have much higher share of their export to GDP. On the other hand, Germany is the #1 export market for 18 EU member countries. For 12 Eurozone and for 18 EU members, in particular from Eastern and Central Europe. Now, why is this so? It is a supply chain. Who runs the supply chain? Is the German industry, and in particular the mid-sized firms, which employ 70% of the workforce, and even more percentage of the training on-the-job training for young people, which is one of the major reasons that there is almost no youth unemployment in Germany to create out. The huge part of this mid-sized firms is in industry. It's not in the service business, it's not in financial service, it's in industry. The government is not the exporter, it's the mid-sized firms. The majority is 60 to 70% of all exports is from mid-sized firms. And there is an interesting analysis being made under the title Hidden Champions, which means there are firms who no one knows. By the definition and criteria of sales are in average of 400 million, but maybe up to 2 billion of sales. They're either #1 in the European market or #1 in the US, or #1 to 3 on the world market. So there are in the world 2,600 firms identified in that criteria. 1,300 of them are in Germany, 300 in Austria and Switzerland. So out of the 2,600, there are 1,600 in the German-speaking Europe. These countries, these companies have an average export rate of about 70%. They don't have an export strategy. They target the world market in a particular field, and the German market happened to be a part of that. Their financing is basically through retained earnings. Bank financing is much too large in German market, whereas capital markets don't play a major role. And as 92% of all firms in Germany are family-owned, it's easy to run them on this retained earnings. Now, what has that to do with the general debate? The Commission actually in December last year had a new plan, and that is to increase industry share of GDP all over Europe. It has decreased in all Western European countries since 2000, except Germany. Among others are Czech Republic, Hungary, and sort of about 23 to 24% of manufacturing of GDP, whereas half of that in France, UK, and even the US, like 10 or 11%. Manufacturing export account for 50% of total exports in Europe, and that declares why a country which has a high industrial share of GDP has, by definition, to have a higher export rate. So Germany accounts for 30% of all industrial gross value added in Europe. Now, many European countries have little exports to emerging markets, and that is the key thing. You have a few countries in Europe, and those are those who are aligned with the German export, the German world market firms, who are profiting from globalization. You have a number of other countries who are not profiting from globalization, and I think this rift is going to be much more important in the long run than the present debt crisis. What is it? It is either it's the car industry. Everybody knows this in this country or in China. 3 firms who have 75% of the Chinese market. Or it's the machinery industry. In the machinery industry, it's all very small to mid-sized firms, about 4,000 to 5,000 in this, who are very active in this field. And so this exports of the manufacturing industry is largely driven to emerging markets outside Europe, whereas a lot of other European countries have major export markets in Europe, in the Eurozone, and that declares the disparity we see, it's a funny thing, at the same time when the Commission is decreeing that they're now shooting for a higher manufacturing percentage of GDP in all European countries, they have started a procedure against Germany for exporting too much industrial goods. It's up to them to understand. What is the implication for the trade between Europe and Asia? Asia is 42% of total EU trade. Europe and Asia are each of the largest trading partner. The debt crisis has slowed it down, so it is also good for Asia if this is coming to at least to some, I'm not saying to the end, but if this would be sort of bending down a bit. China is the most important trading partner for Germany now outside the EU. German exports to China now are higher than to the US, and China is a larger trading partner now than the United States. Without Germany, EU would have a major trade deficit with China and actually with the rest of the world. The interesting thing is that out of Chinese exports to Europe, 34% go to Germany, but from EU exports to China, almost 50% are from Germany, and that is the machinery industry, the mid-sized firms. Those are a few thousands already active here in China. And therefore, I think Europe has a major problem to solve. 7% of the world population account for 22% of world GDP, but account for 50% of all social spending, 7% of the world population. No one believes that this can continue, and there is unfortunately a tendency even now in Germany to say where the third plenum is asking for more market and more increased private sector. The new coalition in Germany is for less market and for less private sector. So maybe it's a preemptive move in the debate of the current account surpluses for that. Let me close on that the only way to get out is through this increased innovation pace. I'm not going into any details on that. But I think, and that is something for China, we probably see that between the German industry and China, the debate is rather not in the future about low-cost labor, it's rather about innovation pace. And here, the structure of the industrial firms will play a major role. And the lesson for China is that new firms started to become a mid-sized firm run by families and private individuals are probably much more flexible to adapt to changing markets than the state-owned enterprises. So one lesson is definitely that the Mittelstand can play a role even in the debate here in China. And let me close with that.
Thank you very much, Peter. Thank you very much for the description of the EU, the issues, and the Mittelstand. I thought it was very, very, very insightful. I just need to remind you that the German word that is now very much in the vocabulary, other than Angst and Mittelstand, is Schadenfreude, which is what. And so, as you know, a lot of people in China are extremely grateful that Germany is now the leading exporter in the world and has a larger current account surplus than China. And so all the angst are now against Germany rather than China before. So, but anyway, I think, your position, your insight into the blueprint about a kind of a European EU type blueprint may not necessarily fit the Asian situation. There are pluses and minuses that Asia needs to think about. So, let me now refer to Liang Hong.
I thought the title is interesting, Searching for Blueprint 2020. This coincidence with this very comprehensive reform plan reviewed by the Chinese government also has quote-unquote a timeline by 2020. It's a very comprehensive, some people say blockbuster reform plan. It contains 60 items. And there's a promise by the government that there will be major breakthroughs on all important areas by 2020. And the part that relates to finance are a few items: interest rate liberalization, a more flexible currency, and increasing direct finance or growth of capital markets. And last, open capital accounts. I think that poses very interesting, really a regime change when we talk about not just Asia, but I think globally as well. But for Asia particularly, if we think about what if the government can fulfill the promises of making major breakthroughs in those areas, what that will lead to. If we think about the interest rate liberalization, the financial repression in China, on one side is you have many depositors getting a very low return on their savings. But on the other hand, you have a lot of large SOEs getting access to very cheap financing. And definitely you got the middle, small, medium firms, the private firms get squeezed in the middle. And once this financial repression gets taking place, and actually if you look at what has happened in China, despite a lot of criticism on shadow banking, but what really happened is, I would say the tiger is out of the cage already, interest rate liberalization. So you see deposit rates, risk-free rates going up in China. And very simple math, 1 percentage point increase in deposit is equivalent to 400 million, no, actually more, 400 billion RMB interest income for residents. On the other hand, you have cost of capital already on the rise for SOEs. But this is one thing different this time. Despite a lot of people said, oh, cost of capital rising, it will hurt China's growth. I said, wait a minute. Do we hear cost of capital increase for private firms this time around? Each time in the past 10 years when China tightens money supply, you hear gray market interest rate going up. This time, actually, we hear cost of capital for good private companies are actually coming down. So there's a central bank survey for Wenzhou financing. The rate has started to decline since February. So you get really what textbook predictions here. The lending rate, the weighted average lending rate may not move. But you would have SOE's cost of capital increasing, but you would have more private companies have access to funding first. Then good companies actually may enjoy lower cost of capital than some large SOEs. At the same time, you get depositors' income increasing. But that doesn't necessarily mean banks' margins are squeezed. They are on the margin, but very small. It's just the disappearance of a lot of gray income. When the economy grows like 10%, how can their cost of capital be 4%? There is a very inefficient way of allocating capital behind all the statistics. So what we're seeing here is really the disappearance of a lot of gray income here. Not necessarily just the bank's margin. The bank's margin, 300 bips, is nice, but it's not extraordinary. So this is what we have already seen. But the others that has made the financial industry very exciting is the remarks by the governor of the central bank. He said he would hope the central bank would refrain from daily interventions in the currency market. And it's everybody's guess which way the currency will go. And I have always been firmly on the side. I think the currency will go up if we don't have a last purchaser by the central bank. But I think the currency adjustment will eventually help balance this domestic demand vis-a-vis external demand equation. And increasing capital market development. So we already seen last weekend, the CSRC said they would from now on aiming at a much more free kind of listing rule than in the past. I think that will also changing the landscape. When we talk about Asia, a lot of problems is really, China is, as a large country, if you think about how the financing is done, such smaller capital market. There's always a debate why Anglo-Saxon model, in particular US, you can't have a banking-dominated financing model. When you have a large geographic disbursement like China, you have to have a lot of local financing available, and the capital market is much better suited to do that kind of financing than banks. And the other one, last one, is capital account opening. What does that mean? And if you look at the experiment that is revealed in Shanghai, very bold. Within 3 months, a lot of measures will be implemented. Half year, they will have a review of the policy, and 1 year from now, they will start to try to copy some of the rules on a nationwide scale. So I think the market has given not enough considerations about what if the 60 items of reforms, even half of that gets done by 2020, what kind of landscape we will be looking at of China, but really the region and globally. And I think if we look at the region, there are also a few very important macro pictures here. Asia as a region, definitely, if we look at the aggregate GDP, is already larger than US, larger than Europe. If you look at the size of population, a few times. Then, as Dr. Fung said, the income disbursement is much wider. However, it is narrowing. With that, also, the bloc, Asian bloc, we have more savings. We have actual savings that each year we export it out. But the region has many poor countries and has many countries that has a huge infrastructure deficit. Could we start to mobilize the saving for the regional use? And I think some of the development by the government, they're selling their highway speed, they're trying to set up an infrastructure bank for the region. All of that, I think, will help to really use the savings generated by the region here. I think if we look at all of that, I think some of the questions posted by Andrew, if we dare to dream by 2020, I think the real economy size, I think we should consider an emergence of an Asian bloc. It won't be like Europe. However, I think rather than the region being part of the production chain, which everybody is so used to, this will be a source of demand. If you look at the intra-regional trade of Asia, so much lower than Europe. The potential for deepening trade within the region, the division of labor, the efficiency improvement potential is huge. And I think with that, an emergence of another Asian currency, not the yen, not the dollar, but RMB. If you look at, I think for SWIFT, I already said for trade credits, the RMB has already overtaken Euro. But if you look at the swaps China has signed and the percent of trade settled in RMB terms, and also a few regional central banks start to hold RMB as part of the reserve currency, I think that really incrementally will also change some of the picture of how you really assess risk, because we were at the whim of dollar for all the past few decades. And lastly, more integrated capital markets, because the governor also said in a few years, they didn't say by 2020, but I think capital account opening, the elimination of quotas for QFII and QDII eventually will definitely make the regional capital markets much more integrated. And when you think about capital markets, this more equity, minimum debt, fixed income products, I think that has to change with China first. As a large economy in the region, if their financing structure started to be more fixed income, more bonds, more capital market, that will have implications as well. I think that's some much more positive pictures to look forward. I think the risk definitely is on risk management, but also on policy. I won't say coordination. How the world deals with a rising China economy, but also from a financial market perspective. This is an emerging market, and they're very early days of learning finance. However, I think the size of the real economy has become much more predominant than the finance side. So how really global major economies coordinate the policies and how risk management is done in such an environment within each country, I think will be a challenge. Thanks.
Thank you very much, Liang Hong. You talked about, I've never heard anybody describe the third plenum document as a blockbuster. But obviously you are a star in, giving an exposition on this issue. Now, on this movie theme, time is constrained, so I'm going to ask only two questions, if you don't mind, right? The first one is actually to Richard. I think that I was asked by somebody, that given that, Abenomics is the other blockbuster, in Asia, is it going to be Rashomon or Yojimbo?
Well, it has 3 arrows. First arrow produced what I call the honeymoon. Stock market going up 80%, Japanese yen coming down by over 20%. Completely transformed the Japanese landscape. People have become a lot more optimistic, a lot more positive about the future. But when you look at who produced that honeymoon, it was all foreign fund managers. Japanese money did not go into the stock market, did not push the yen down. They all stayed in the bond market. And the Japanese knew why that was the case. There are no private sector borrowers in Japan. And there are no private sector borrowers in the United States or in Europe or in the UK either. If you look at the macro picture of all of these economies, none of them have private sector borrowers. Every one of them, private sector is actually saving money or paying down debt at 0 interest rates, just like Japan. But if you're in that situation, no matter what the central bank does, money multiplier is negative at the margin, nothing should supposed to happen. That's why the Japanese investors who lived through this the last 20 years said, there's no reason this crazy quantitative easing should work, so they all stayed in the bond market. But thanks to the foreign investors who didn't know enough about this, the whole landscape was changed, so we call that the honeymoon. But in middle of April, early May, bond market then finally realized that if foreign investors do get their way and we're going to have inflation, they cannot be holding on to JGBs yielding 0.8%. So they dumped the bonds, and then the honeymoon stopped. That's where we are now. So that's the end of the first arrow. The second and the third arrow, one is fiscal stimulus, the other one is structural reform. Fiscal stimulus is absolutely essential. And I hope a lot more people pay attention to this one, because Japanese private sector is saving 8% of GDP at 0 interest rates. So someone has to borrow the 8% to keep the economy going. And that's the fiscal stimulus. But why are they still not borrowing money after 20 years? Their balance sheets were all repaired by 2005. Interest rates the lowest in human history. Banks very willing to lend. How come they're still not borrowing? 2 reasons. One is the trauma toward debt. After private sector go through this private sector balance sheet repair for such a long time, they said, never again. I never want to borrow money again. And the Americans who lived through the Great Depression never borrowed money until they died for exactly the same reason. they went through this debt hell. They don't want to borrow. And the other reason is that Japan is a mature economy. Everybody has almost everything they want. So what's the point of investing in Japan when there's not much market? So the second arrow is addressing the trauma problem. The third arrow is trying to address the lack of investment opportunity problem. And the second arrow, I think, is moving forward. And they're trying to increase, come up with accelerated depreciation allowances, as well as investment tax credit to get these guys to borrow money again. And the third arrow is this time trying to open up markets. And that was together with TPP. And if they do open up markets, there's still so many regulated markets in Japan. If they open up, maybe companies will find investment opportunities inside Japan. That's the whole idea. But the third arrow, I'm afraid, is in the right direction, but going very slowly. But it's still going in the right direction compared to all the other ones that we discussed in the last 20 years, like the Koizumi's reform, where a lot of foreigners got excited. That one was all designed to increase lenders, not increase borrowers. The privatizing postal savings, all that was designed to increase lenders. But there were no borrowers in Japan. Only the government was the borrower. So that was not going in the right direction. This time, they're trying to increase borrowers through deregulation, and so it's in the right direction. But the speed, I'm not particularly happy with.
Good. Thank you very much, Richard. I think last word, I'm going to ask the Antonio Banderas of Asian finance, Rafael, because you gave up quite a lot of your time and let you have the last word. Okay.
Well, thank you. Thank you, Andrew. And my goodness, between my father-in-law and this actor, I don't know what this movie is about. But the renminbi regionalization. Okay, let me just maybe share with the room the concern. Okay, on one hand, you want to enhance what Jiang Hong was saying, which is a lot more intra-Asia trade. Okay, it would be very comfortable to have that in a single currency. Okay, and that would be the renminbi. They're exporting into China, importing from China. So the issue is, how can companies in Asia hold on to renminbi balances and avoid what I guess any authority would want to avoid, which is that there be a lot of trading amongst banks and financial players that would bring the value of the renminbi up and down against the other major currencies, irrespective of the real economy. Okay, so this is the conundrum that I guess we are all struggling to play with, because we're all believers in a regionalization of the renminbi, but when you start to think, it's going to have the volatility unrelated to imports and exports that the yen has against the dollar, that the euro sterling has. So, anybody keen to come up with an answer to this Banderas question?
Good news. I've just been told that we've got some more time. So I will now ask any of the other panelists who want to answer Rafael's question.
I think it's a good challenge, but it depends on what. You still have people who think the RMB is already overvalued. In that case, your problem is not there. But if I think you share some of my view, which I think the currency, from a cyclical perspective, has a lot more to go here.
Sorry, maybe I'm interested in
the swings, right?
Swings that are not reflecting
the real economy.
Because China has got a tremendous surplus, so it has to have currency. The question is, thereafter you have up and down.
But I think U.S. has offered a good role model for itself. Right? As a large continental economy, internal balance is the most important thing. So, although I think my currency problem is a little bit too arrogant, but I think that's probably the way to go. So internal balance is most, and in a way, with the currency just started to become an international currency, you could have a lot more real demand than just the speculative. And for the region, there are a lot of countries hold a natural current account surplus vis-a-vis China. But I think the next round, how the RMB is going to go abroad is through investment, just like Japan. But I think at the end of the day, this one is going to be different than Euro and Japan. In any case, I always think the model that is mostly relevant to China is US.
On the renminbi issue, United States is doing exactly what it used to do to Japan by saying open up markets and push the exchange rates up, because at that time Japan was running a huge current account surplus. And from 1980, Japan, unlike China, tends to listen to the American pressure. So they set up this yen-dollar committee to open up Japanese financial market. And guess what happened? Yen weakened and weakened and weakened until U.S. industries were so completely devastated that they had to come up with the Plaza Accord. And what they didn't understand was that Japanese market was largely closed to capital flows until 1980. And it was in, I think, December of 1980 that the market was finally, in principle, opened up. But then there's so much money inside Japan that wanted to go out, and that completely overwhelmed the money that was coming in. And so yen depreciated very significantly for nearly 5 years, from 1980 to 1985 September. And then Americans who started the thing couldn't take it anymore. So they came out with the Plaza Accord to reverse the move. So in the short run, and short run could be 3, 4, 5 years, things can go completely in the opposite direction. And we should be aware that there are a lot of Chinese people, a lot of rich Chinese people who love to move money abroad. And you see that in San Francisco and so many other places, right? And so, there could be a volatility of this sort, at least in the medium term, until fundamentals catch on again.
Actually, there are two remarks. One on the trade, intra-block sort of trade. I fully agree with you. I think there's a lot of leeway for that, and we see a dramatic shift in the last sort of 2 years already. If you look on the ranking, and whereby the countries in Asia and Southeast Asia and China are moving ahead and become number 1, 2, or 3 most important trading partners for each other. So that's definitely going to happen. And but don't rush into a common currency. We could tell you something that's not to do on that. The second remark is on the yuan. I think there is a possible role model of the development could be the emergence of the Deutschmark to become at the time the second most important currency in the world. Why? It shows that from 1933, with the end of Bretton Woods, and when they all 71 went off gold, the US in 73 introducing of the flexible exchange rate, is the permanent upward pressure, slowly upward pressure on the Deutschmark. It's one of the major reasons for the success of the German export industry and for the competitiveness of the industry. It led and helped to restructure the industry, moving it to a next level, making it more productive, bringing new products and services. And I think that is, to look into this, maybe for China, one of the most important lessons to learn is that the flexible exchange rate could do more for a positive restructuring of the industry and bring it to better products and higher efficiency than any other political measures you could think of. And that was the reason why Governor Joe was very interested in that. And Chu Min and I, we published last year the book about currency policies and economic development post-war Germany. Funny enough, the book came out first in Chinese, and now it's coming out in German, actually, by the end of this year. So much for that. And the third point, I think the global economy is in, of course, much better shape than ever before. But you have different patches, and the problem we see is that you have two groups of countries, very simplified. High growth, low debt, good demography is one group. China may be in the middle, rather, in the demography. And another group of countries which have low growth, high debt, and bad demography. So unfortunately, the latter part is Europe. The first part is definitely mainly Asian and Arab countries. And the US and China is, in terms of demography, in the middle, in that the US is in the European group, and in that China is in the group of the other emerging market countries. So this may give an indication on where economic dynamics may move in more in the years to come.
Thank you. Just to follow Richard's remark on the courage needed by the central banker, I think the world will do the same mistake again and again. If we go back to the last crisis or the ongoing crisis, actually, I still remember on 2008, January 15th, the G20 Financial Summit issued a statement which already gave out a warning. And on the same day, I took the chairmanship of Megabank, which is from the merger of the Jiaotong Bank and Taiwan's ICBC. I still remember that on that day, I issued 3 mandates. First one, to cap the mortgage lending limit. Second, to stop buying the assets from in the international markets which are not really known to us. Third, to provide as much reserve as we can, which gave me a huge damage on my year-end bonus because of the reduced bottom line. But it helped the bank to weather through the crisis. Actually, 3 years ago, the US Senate's Financial Crisis Inquiry Commission, if we go back to read the summary, it reminds us that the crisis could happen again. And he said last crisis was avoidable. However, people will probably do the same mistake. So that's how, since I served as a board member of central bank for 2 years, so I could understand why our central bank was so firm on fighting hot money, which did cause some turbulence in the past. So let's look at the future, envision the possible changes, and prepare to tackle the problems. Thank you.
Thank you, Joseph. I think time is of the essence, so let's stop here. But we clearly, Asian 2020 will not have one blueprint, because Asia will not be one view. There'll be plenty of different views. We've got a lot of lessons to draw from, but let's move forward step by step. Thank you very much indeed, and we'll all go down for lunch. And let me thank all the stars of this panel. Thank you all.